Professor Finley here. War in the Middle East, oil supply in chaos, inflation rising, stocks and bonds falling, and gold, the so-called ultimate safe haven, is down 10%. Let that sink in. While the world is burning, the one asset that should protect you is falling. Here's the uncomfortable truth. Gold isn't falling despite this chaos. It's falling because of how the monetary system is reacting to it. In the next few minutes, I'll show you exactly why this is happening and what it really means for your wealth. On February 28, 2026, the United States and Israel launched a joint military operation against Iran. The operation killed Iran's supreme leader, Ali Khamenei. Iran retaliated with missile strikes against U.S. bases in Jordan, the UAE, and Qatar. And then Iran did something that changed everything. It closed the Strait of Hormuz. The Strait of Hormuz is a narrow waterway, at its narrowest point, 33 kilometers wide, through which approximately 20% of the world's daily oil supply flows. Every day. Roughly 14.5 million barrels of Persian Gulf crude. The International Energy Agency called what followed the largest supply disruption in the history of the global oil market. Not the largest this decade, not the largest since 2008, the largest ever. By March 5th, Brent crude had jumped 15% to $83 a barrel. It peaked at $126. It currently sits near $96. Goldman Sachs has upgraded its Q4 forecast to $90, with an adverse scenario above $100 if Hormuz doesn't normalize by end of July. 200 ships are wandering the region with nowhere to go. Saudi Arabia's largest refinery has been hit by drones. Qatar's export facilities targeted. Shell warned Europe could face fuel shortages as early as April. Tungsten surged 50% in March. Aluminum up 8%. The UAE's Emirates Global Aluminum facility was hit directly. This is not a regional skirmish. This is a global supply shock. Now back to the question that opened this video. Gold peaked at $5,303 per ounce on January 28th. It is currently trading near $4,072, the lowest level since November. That's a $1,231 drop since the all-time high. A 23% decline. In the middle of the worst geopolitical and energy crisis in modern history. Morgan Stanley's Amy Gower summarized it coldly. With the conflict triggering an energy supply shock that has reduced hopes for lower U.S. interest rates, it is not surprising that gold has struggled to work as a safe haven this time. Not surprising, she says. Let's decode that. In 2025, gold was in a clean bull market. Markets were pricing 2 or 3 Federal Reserve rate cuts by the end of 2026. Real yields were drifting lower. Gold doesn't pay interest, so when real yields fall, gold becomes relatively more attractive. The tailwind was perfect. Then the war started, and the tailwind became a headwall. Oil surged. Oil means energy costs. Energy costs mean inflation. Inflation means central banks cannot cut rates. No rate cuts means real yields stay high. High real yields mean gold is less attractive compared to bonds and cash that actually pay you something. The CME FedWatch tool now shows 0 rate cuts as the dominant scenario for all of 2026. Market-implied odds of a Fed rate hike before year-end now exceed odds of a cut. Translation: the war didn't make gold more valuable. It made the cure for inflation, higher interest rates, more likely. And higher interest rates are gold's kryptonite. Here's where Roland Botter would arrive with a comment. He'd say, "We built a monetary system so fragile that a war in the Middle East is bad news for the one asset that has stored value for 5,000 years. Congratulations." He would not be wrong. There's a word for what's happening. Stagflation. stagnant growth, high inflation. Simultaneously, it's the economic condition central banks fear most, because their tool only works on one side of the problem at a time. Want to fight inflation? Raise rates. But raising rates slows growth, and the economy is already slowing. Want to support growth? Cut rates. But cutting rates fans inflation, and inflation is already running at 4.2%, the highest since April 2023. Energy costs alone drove more than 60% of the monthly CPI gain in May. This is the stagflation trap. And the Federal Reserve, now under Kevin Warsh, who took his oath on May 22nd, is sitting right in the middle of it. The June 17th FOMC meeting was priced at a 96.5% probability of no change. Warsh held. But the lone remaining rate cut expected for 2026 is expected to vanish from the Fed's dot plot entirely. The Austrian School has a precise word for a central bank caught in this position. Concerned and cornered, central banks historically make one of two errors. They fight inflation too aggressively and cause a recession. Or they capitulate on inflation and cause a currency crisis. Mises described both outcomes in Human Action in 1949. He called them the two exits from an inflationary spiral, and he noted that neither is pleasant. The 1970s are the obvious historical reference point. The 1973 OPEC embargo sent oil from $3 to $12. The 1979 Iranian Revolution sent it from $15 to $35. Both produced the same result: inflation, stagnation, and a Federal Reserve that couldn't contain it without Paul Volcker eventually raising rates to 20%. Gold, for the record, went from $35 in 1971 to $850 in 1980. The 1970s were terrible for the economy. They were extraordinary for gold, not immediately, not linearly, but ultimately. So when does gold actually function as a safe haven? The answer from history is specific and important. Gold doesn't rally when there's inflation. Gold rallies when there's a credibility crisis. There's a difference. And Euronews's commodity desk put it cleanly. Gold's real moment arrives when confidence breaks, when inflation becomes unanchored, when the central bank is seen as unwilling or unable to stop it, and when investors start to question whether the currency itself will preserve purchasing power. Right now, the Fed still has credibility. Markets believe Warsh will fight inflation if he must. That credibility is what's suppressing gold. But credibility is not a fixed quantity. It erodes, slowly, then suddenly. In the 1970s, it took Arthur Burns 7 years of wrong decisions to destroy Fed credibility completely. In the Eurozone debt crisis, it took Draghi's whatever it takes to restore it. Here's the Austrian question. At 4.2% inflation, with oil near $96 Brent, with a war nobody can end, with $39 trillion in federal debt that becomes more expensive to service every time rates go up, how long does that credibility last? Goldman Sachs still forecasts gold at $5,400 by year-end, anchored by central bank buying and the eventual return of rate cut expectations. Around 70% of central banks surveyed at Goldman's recent conference expect global gold reserves to rise over the next 12 months. Roughly the same share expects prices to settle above $5,000 within a year. Central banks, the same institutions that print the money gold is supposed to protect you from, are quietly buying the gold that protects you from them. Botter called this kind of thing the self-incriminating testimony of power. There is a longer story underneath all of this. Iran didn't just close the Strait of Hormuz. It began charging yuan-denominated transit tolls for tankers passing through. The world's most important oil choke point is now billing in Chinese currency. Indian refiners are settling Russian crude purchases in yuan and UAE dirhams. the first time a top 5 oil importer has structurally bypassed the dollar. Russia and China now settle more than 90% of their bilateral trade in their own currencies. Saudi Arabia has begun accepting yuan, rupees, and dirhams for oil, not just dollars. The Petrodollar system, the arrangement established in 1974, where oil is priced globally in US dollars, creating synthetic demand for the dollar worldwide, is under its most serious structural test in 50 years. And central banks know it. That's why they're buying gold. Not as a short-term hedge, as a long-term pivot. Central banks purchased over 2,100 tons of gold in 2022 and 2023 alone, a post-Bretton Woods record. And since 2019, the Bank for International Settlements, the central bank of central banks, has officially classified gold as a Tier 1 asset, the highest possible classification, equal to cash and government bonds. The same institutions that told you gold is a barbarous relic quietly reclassified it as the safest asset on Earth. They just didn't tell you. The BRICS currency, which multiple nations are actively developing, is widely expected to be at least partially gold-backed. A historic return of the gold standard through the back door. Mises spent his entire career arguing that sound money, money backed by something real, something that cannot be printed at will, was the precondition for a functioning economy and a peaceful society. He was laughed at in 1971 when Nixon abandoned the gold standard. The world has been running his experiment in reverse ever since. And every crisis since then, 2008, 2020, 2026, has been a chapter in the consequences. Let's bring it all together. Gold is falling right now because the Iran war made inflation worse, which made rate cuts less likely, which made real yields higher, which made non-yielding gold less attractive to paper traders working on a weekly time horizon. That is true. And it is completely irrelevant to the Austrian framework. The Austrian School doesn't analyze gold on a week-by-week basis. It analyzes the structural conditions of a monetary system and asks whether those conditions are stable. Here are the conditions in 2026. Federal debt, $39 trillion and climbing. Inflation, 4.2%, and driven by supply shocks the Fed cannot control. The Stagflation Trap, a central bank that cannot cut without igniting inflation and cannot hike without triggering recession. The Petrodollar, under its most serious challenge in 50 years. Paper gold, trading at 200 to 1 over physical supply. Central banks, buying physical gold at record pace while publicly managing fiat currency systems. This is not a stable system. It is a system where every participant at the top is quietly hedging against the system itself. Hayek called this kind of structure the pretense of knowledge. Institutions managing something too complex to manage, creating fragilities they cannot see until the moment they matter. Mises called the endpoint the crack-up boom, the moment when the public loses faith in the currency and rushes into real assets faster than the system can absorb. Botter described the whole arrangement more simply. He said, "A currency backed by nothing is a promise made by people who have every incentive to break it. Gold is down today. It may be down tomorrow. The paper market is watching the Fed. The paper market is watching Hormuz. The paper market is watching Trump's ceasefire tweets. But central banks aren't watching tweets. They're stacking physical gold at record pace. Because they know something the paper market doesn't price in. The long game. The Iranian war will end. Hormuz will reopen. Oil will fall. Inflation will ease slightly. The Fed might cut once. Gold will rally on relief. And then the structural problems will still be there. $39 trillion in debt. A petrodollar under challenge. Paper claims on gold that outnumber physical gold 200 to 1. A monetary system that requires permanent expansion to avoid permanent contraction. Mises knew where this ends. He wrote it in 1949. The question is not whether gold wins. The question is whether you're holding it when it does. That's it for today. If this video gave you a clearer understanding of how the world really works, I'd appreciate it if you subscribed and turned on notifications. We'll continue exploring these topics regularly. Thanks for watching, and I'll see you in the next one. Professor Finley.